Hi, this is Jin Rong, Market Strategies for IG Singapore. Despite some inflation jitters brought on by the hotter than expected US CPI print this week, Wall Street managed to regain its footing with the S&P 500 delivering yet another fresh record high. It seems that markets have escaped unscathed while market participants recalibrated their rate expectations to be more in line with the US Federal Reserve. Back in Asia, Japan's Nikkei stole the limelight, briefly touching the 38,800 level for the first time since January 1990, and is standing just less than 2% away from a new record high. The STI has also seen renewed signs of life this week, gaining more than 4% since Wednesday to reclaim its 200-day moving average. Heading into the new week, there are three things on our radar. First up, the US earnings releases will leave spotlight on Nvidia's results as the key risk event for markets, given that Nvidia has accounted for the bulk of the market rally through 2023 and into 2024. Since the start of 2024, Nvidia shares have gained more than 50%, reflecting strong growth expectations in place and hence leaving little room for error. Thus far, corporate earnings momentum in the current earnings season has been robust. As of last week, 79% of S&P 500 companies have released their results, with 80% delivering an earnings beat, which towers above both the 5-year and 10-year average. Next, we have the US FOMC minutes out in the wee hours of Thursday. In its January session, the Fed has kept the Fed funds rate steady at 5.25% to 5.5% range for the fourth straight meeting. The Fed also updated its policy stance, indicating that rate cuts are on the horizon, though not in the near term. Although markets may place greater focus on the recent run in economic data to form expectations of rate outlook, the minutes will still be on watch for any clues relating to the Fed's balance sheet strategies, potential timing for rate cuts, and perceived risks to the global economy. Lastly, we have a series of flash PMI data releases, particularly from the US on Thursday. Last month, the US PMI numbers have revealed a stronger upturn in economic activities, with the manufacturing sector delivering its highest rate since September 2022. Growth in services has been robust as well, delivering its fourth straight month of increase. The takeaway from the subcomponents reflect lukewarm economic growth in US alongside waning cost pressures, which may be encouraging for soft landing hopes and impending rate cuts potentially in June this year. The upcoming PMI read is expected to reflect more of the same, with the manufacturing sector expecting to ease to 50.1 from previous 50.7, while the services sector PMI may ease to 52 from previous 52.5. That's all for now, and I will see you next week.